Moody's Investor Service has assigned first-time B1 local currency deposit ratings to Equity Bank of Kenya and the Cooperative Bank of Kenya. Moody's attributes the rating level to the bank's standalone strength as indicated by their B1 standalone BCAs, Moody's highest ratings in Kenya. The ratings firm, however, notes that lending rate cap has constrained the bank's flexibility to price risks. Christoph Teofilou is Assistant Vice President and Banking Analyst at Moody's, joins us now. Christos, definitely a pleasure speaking to you, and the timing couldn't be more perfect. Now, these banks have reached this rating based on the standalone strength, and we are yet to see, in such a segmented market, we're yet to understand what exactly a standalone strength means, knowing very well the kind of pressure that has been placed on the Kenyan market currently. Just give us your view on what exactly this means.
Sure. Hi, George. Thanks for having me. As you mentioned, we now assigned ratings to Co-op Bank and Equity Bank. In addition to KCB Bank that we already rated, now we cover the top 3 banks in Kenya in terms of credit ratings, and we cover about 35% in terms of domestic assets. As you rightly stated, the B1 global scale rating reflects the standalone credit strength of the banks, and in arriving to these ratings, we first of all start by looking at the operating environment with these banks operating in. This assessment takes into account, on the one hand, the long-term strong growth prospects of the Kenyan economy. On the other hand, we also looked at certain structural constraints that currently weigh on the bank's asset quality and loan growth. So on the one hand, we look at the overall operating environment. We assess the bank's relative buffers in order to withstand the challenges of the current operating conditions. And the similarities of these two banks are they have very solid loss absorption buffers in terms of profitability and capital. And they also have strong retail deposit franchises. So these buffers, in our view, place the banks well to withstand the challenges in the current operating environment.
Just help us understand how much of this actually relates to the short-term foreign currency and local currency IDRs. We've seen it on a global scale. We're here to understand what role the banks play with such ratings.
I couldn't hear you very well, George, but if I understood your question was regarding the local currency. Just to explain a bit, the global ratings speak to international investors that want to compare Kenyan banks with other banks globally. As part of the ratings of Equity Bank and Cooperative Bank, we also assign what we call national scale ratings, and these speak to the domestic investors. And the national scale ratings allows a greater degree of diversification between different companies operating in one jurisdiction. And it allows investors operating within Kenya to better distinguish between the credits in Kenya. And the ratings of both Equity Bank and National Bank on a national scale rating, AA1.KE and AA2.KE respectively, indicate that they are one of the strongest credits at the moment operating in Kenya.
Right. Let's move on to other matters. The debt to GDP, of course, is something that most banks are being looked at to try and somehow fund the deficit, but this remains averagely below par. Is this in any way a reflection of our ability to narrow this gap, or is this something that we need to look forward to past the banks particularly?
Against George, apologies, I couldn't hear you very well, but if I understood correctly, your question was on the debt levels of the government. And my focus is mainly on the banking system. So although it's an interesting question, from the banking system, we look more on the effects that the spending of the government has. For example, we've seen high infrastructure spending by the government in this environment. And actually that has benefited the real economy, the economy where the banking system operates in. So although obviously this leads to higher debt levels for the government because of a lot of this spending is going towards infrastructure, it is supporting the real economy which the banks lend to. And also it does support the longer term growth prospects of the economy because a lot of these infrastructure spending is on productivity enhancing areas which should support the longer term growth of the economy.
And finally, what possible solutions are we looking at in terms of cushioning the banks against these price risks? They're having a lot of issues with their flexibility.
Yes. In terms of the buffers that we look at, obviously we rate a small sample of the banking system. We rate 3 of the largest banks, the tier 1 banks. So my comments will be more focused towards these 3 banks. Obviously, there are some smaller banks in the system that face more vulnerabilities. But regarding these three banks that we do rate, we generally see a strong profitability that allows them to absorb potential further losses on the loan book. We also see high capital levels and strong funding and liquidity profiles because these 3 banks have the strongest deposit franchises in the country. They have a granular retail deposit franchise that allows them to withstand the current challenges that we're seeing in the environment. So to summarize, yes, there are short-term challenges that are affecting the 3 banks in various degrees, but we also look at the relative buffers that they have, and at the moment, these are quite strong as well.
Right, thank you very much for creating perspective. I really do appreciate that. Christos Teofilou, Assistant Vice President and Banking Analyst at Moody's.